payments on account, who has to pay them, when do we have to pay them by, and how do we calculate them? So who's going to need to pay a payment on account, and then most importantly, who's not going to have to pay one? You are going to have a payment on account unless the amount of tax owed for your prior year was less than £1,000. That's the amount of tax you owed when you submitted your tax return, so that's not the amount of tax you owed and was paid directly over to HMRC via something like pay as you earn. That was the amount of tax that was outstanding for your untaxed income, less than £1,000. Last year you paid more than 80% of the tax due outside of self-assessment. So the people most likely to get away with no payment on account because of this one is going to be people who have a full-time job, so most of their income is taxed via pay as you earn. So they maybe are filing a tax return because they have something like a child benefit they need to tax, or maybe they've got some bank interest, something like that. Let's have a look at the calculations. So I'm going to use this example of the 6th of April 24 tax year to the 5th of April 25 tax year. But remember, just roll the tax date forward depending on which year you're watching this video, because it's the same thing every year. So on the 31st of January 2025, we will have made our first payment on account. On the 31st of July 2025, we'd have made our second payment on account. If this is your first year doing a self-assessment tax return, don't worry, you won't have had any payments on account to make, but when you file that tax return, you might have payments to make. So it's still good knowledge to have, even though please don't panic because you haven't missed anything. So let's look at an example with some numbers because I think it's much easier to see that. Our tax return for the 5th of April 2025 is due on the 31st of January 2026. Tax due on the 31st of January 2026 is £6,000. We've made payments on account of £2,000 in January 2025 and £2,000 on the 31st of July 2025. So we take those payments on account off our tax bill because they're payments that we're basically making in advance, because that's all that payments on account actually are. They are us making payments of tax in advance of that tax being due. So we knock them off our tax bill at the end of the year. So we have a balancing payment to make then of £2,000. And that will be due on the 31st of January 2026. So for example here, say you made less money this year than you did last year. Then you might have a tax due of a lower amount. So say I had tax due of £3,000 here, then I'd be getting a refund from HMRC of £1,000. So depending on your circumstances, and circumstances are always changing, but also on the 31st of Jan 2026, we're going to have a payment on account due in relation to the 5th of April 2026 tax return. Balancing payment £2,000, and that's going to be plus our next payment on account. So the next payment on account is going to be £3,000 because our payments on account are half of the prior year's tax bill. So £6,000, half of 6,000, 3,000. So it's going to be £2,000 plus £3,000. Total payment due on the 31st of Jan 2026 would be £5,000. Now, just an important thing to note here, your payment on account is calculated as last year's tax bill divided by 2 plus your class 4 national insurance contributions, again divided by 2, because obviously you make 2 payments on account for the year. Really what HMRC is saying here is if you have had £6,000 of untaxed income last year, then you're already going to have paid it by the time you get to submitting your tax return the next year. So you're not ending up with a massive tax bill on the 31st of Jan. It's trying to prevent people being unable to pay their tax all at once, basically. So they're spreading it out for you throughout the year. Whereas if you were on something like a payroll, because you were employed, you pay your tax over every month and it's very easy to keep on top of. Whereas with untaxed income, it can be a little bit more challenging. And just remembering, class 4 national insurance contributions are of course only applicable if you are self-employed. And that's people who are self-employed, that is not company directors who own their company and take out a dividend. There is no national insurance contributions on dividends, just to be clear there. But what if I've had a change in my circumstances during the year? So say from tax year from 6th of April 2025 to 5th of April 2026, I've actually then become employed. So I've left my self-employed business and decided to become employed. And my pay is now being taxed via pay as you earn. So I'm no longer going to want to make such a large payment on account in January. Well, you need to let HMRC know. When you let them know, they will be able to reduce your payment on account. You just have to kind of give them a reason. And something like, I am now employed employed instead of self-employed would be a perfectly good reason to reduce your payment on account, and they shouldn't have a problem with that.